This is eSec Lending Insights. Let's get over to our episode. So it's April 1st. Did you think we would get here?
I figured we'd get here. I didn't know it'd feel this fast.
Yeah, it does. It has sped by. Like everything in the world seems to be happening all at once. How are you guys? What should we talk about first? Should we recap quarter end? Should we talk about there's been some pretty mega updates in the market and the industry in terms of long awaited changes that have also happened? And then there's the general flows and activity of what you guys are seeing in the market. Where do you feel like is a good starting point?
I think quarter end's good to start. Just we're only one day past. So want me to start there?
Sure. Yeah. Let's
Yeah.
hear it.
Q1 tends to be a little bit more anticlimactic because it usually comes right after a year end that tends to be a little messy, balance sheets at
Yep.
its tightest. It felt the same. We saw a blip in funding markets from a rebate perspective, but nothing atypical, just a couple basis points. It felt like borrowers had a pretty good handle on their sheet this time around, meaning those that were going to be tight gave us a pretty early heads up that it's going to be tight. And those that were not tight and had ample capacity, we basically were just swapping around collateral. So if you look from a kind of new loans to returns perspective, a lot of the intraday numbers look like there was a lot going on. If you just net everything out, our balances were pretty sticky, utilizations were pretty sticky, and then rebates were not as high as maybe people usually think for a quarter end and a reporting date. So we take that as a win. Now that we're in the first of the month, fresh quarter, you're already getting borrowers that had to go down in March looking to add back balance now that they're past the reporting date. That's always, in my opinion, a good indicator of demand for certain products and certain asset classes. So, it's always a good problem to have from a lender perspective when you're unable to get them back the same balance right away that they typically had, because if they have to go down intra-quarter, you have to try to replace a lot of that to keep cash numbers and balances as is. So you can't always get them back the same exact amount, but it's a good problem to have. And for that reason, I think we're definitely positive. Looking at some of the volatility that's happened in overnight markets, term structures, I think tend to be, for me, a better indicator of what the maybe 3 to 6 month outlook is going to be for funding. Those markets have really not budged much at all, even with a lot of the geopolitical and Iran headlines. I would say that if anything, they've really improved. I think we talked about this last podcast. The bid on HQLA and kind of the flight to quality trade continues to be there. So expecting cash balances to remain high as we move through Q2 here. And I'm sure in the back half of the year, as certain supply and demand and coupons and issuance increases, you might start to see some of this reverse out a little bit. But for now, I think we're definitely playing offense and adding to the blotters.
Okay. And the last time we spoke, you gave us the update on what the expectation and how it's changed around Fed monetary policy with a new chair looking to be confirmed and brought in mid-year. Any major change in the last week or two on expectations around rates
Yeah.
this year?
Yeah. I mean, swaps markets have really been moving around. It's a lot of people struggling between what does energy prices do to inflation? What does it do to
Mhm.
the overall employment market? What's it do to growth as a whole? There was a quick blip over the last 2 weeks where you started seeing cuts fully priced out, and you actually had a lot of people thinking the next move could be higher rather than lower. So a rate hike. And that felt like a little bit too much of a knee jerk reaction. So you're now getting that priced out a little bit. Looking over the next 9 months here, the curve is pretty flat. If you're looking at Fed futures and OIS swap markets, some of the research houses still probably feel that one cut is still probably the base case. That's what the dot plot most recent projection was. But the longer that the war in the Middle East goes on, I think the further and further back you can kind of move that rate cut expectation. So some of the headline news today and yesterday on maybe optimism around a resolution that could start bringing some of that back. But for now, I think we're operating under the assumption that the curve is probably going to be pretty flat for the time being.
Okay. And Mark, how are things in your world? Obviously, plenty of volatility. How have your funding markets been in terms of cash over quarter end on the equity and the corporates? And what else is taking your attention and focus these days?
Sure. Yeah, I think it was a great quarter. We certainly saw a slight downtick in overall specials activity. Average fee on loan for US equities oscillating in that 40 to 50 basis point range. We've seen it move a bit higher now, but when I look back at the quarter, I think to your point, There certainly was a bunch of volatility. S&P 500 was down for 5 straight weeks to close out the quarter. What that really resulted in was probably a little bit less pressure on sheet. When major indices move higher is when we typically will see sheet tighten up a bit. Demand for LCR trades will pick up. So I think probably around mid-February, it seemed like quarter end would look different than it actually did. We're seeing more demand for some of those LCR structures and term funding repo structures that we really like. Both markets trading lower, I think it took a lot of pressure off sheet. And then one of the direct results of the stress in the market, right? So you kind of had the SaaS apocalypse in January. Everyone told us that software was the most net sold sector. So we certainly saw some borrowing in those large caps and mega caps that are associated with the high flying SaaS names of the past year or two and those high beta securities. And a lot of those are great for funding because obviously they're main index equities. There's no shortage of supply. And then we had private credit happen, right? We saw an uptick in demand for a lot of names that either are directly in private credit or tangential private credit and really consumer discretionary in general to an extent that that was kind of a tag along. ETFs like BKLN and MUB, we saw a lot of borrowing in those too. So I think you can group all of that into a single trade or a single thesis. Sounds like we're certainly not out of the woods yet. We are seeing some consistent demand for some of those private credit names, even if they're not really trading very special. They're a bit off GC and they're a good trade that seems like it's going to stick for a bit here. And then obviously we saw the conflict in the Middle East. So that just brought really more breadth of volatility. The market was making highs in the first half of the quarter, despite some of those other narratives I just discussed. But then we saw oil trade higher, the VIX spiked, the 10-year went above like 4.4. So obviously equities traded lower as a result. I think despite lower mark-to-markets, we saw pretty orderly funding performance across clients, both cash and non-cash, as a result of sheet maybe loosening up just enough. I think what happened too is it seemed like there was just more outright borrowing on a net basis from a lot of the largest borrowers in the market because maybe it was long selling. I'm not entirely sure, but some of the portfolios that I think are more indicative of kind of like sentiment and overall net borrowing, we saw certainly an uptick of flow there too. That's probably my summary on Q1. Did I miss anything?
No, but I have a generalist question for you, and it's going to lead into a comment that we can talk about in terms of major market news, if you will. But equity collateral versus cash collateral that you're seeing, and we've long been very active in the equity collateral space. We have a lot of, in particular, pension clients that have very flexible collateral profiles, utilize both strong cash programs, but also equity collateral programs. Over time, depending upon macro factors, there's been preferences one way or the other. This week, where the SEC has made a change to allow US brokers to pledge equity collateral versus equity loans. But what's been the trend on the last number of months around broker preferences on collateral efficiency? And do you see variations on that depending upon the type of borrower and maybe their domicile or jurisdiction?
Yeah, it's definitely still regional. There's been an increasing desire to set up tri-party buckets. So I think that's been pretty interesting. Are you willing to take a single issue of an ETF instead of requiring it to be in a diversified basket, which I think a lot of risk managers would be okay with that, but it's probably something that's often overlooked when you're setting up issuer diversification requirements and things like that. There's definitely increased demand for convertibles and taking convertibles as collateral. A lot of that, though, is borrower by borrower, region by region. For US dealers where we're more familiar with cash collateral, I think we've seen some of them move in and out of using treasuries as collateral from time to time. So, that was really a trade that I think picked up last summer, and it's definitely carried through to this point. I think it's mostly from a collateral standpoint, probably even more of the same in the sense that it's regional. And then I think some of those opportunities that are a bit more incremental alpha with specific dealers has been kind of those more bespoke structures where it's some type of custom tri-party schedule or something where you're really focused on what are they long, how do I partner them up with a beneficial owner or a couple beneficial owners are willing to expand their collateral schedule for that dealer.
Yeah, interesting.
I was asking Mike what he thought because I know he obviously sees plenty of the funding needs with his lending HQLA versus different collateral types. So he probably has a good finger on the pulse as well.
Yeah, I think some of the geopolitical stuff and kind of the impact on global rates and global central banks has caused a lot of volatility in different currencies. For that reason, we saw some decent basis moves between a couple currency pairs. For that reason, some of the sovereign versus sovereign trades have picked up, which maybe weren't there really to start the year, or maybe a little quieter around the fourth quarter. Fourth quarters tends to be when people start to see the basis start to widen out and some people start layering into this trade. It was definitely a little bit more muted this time around just from where currency pairs and rates were, but that reversed some in the last couple of weeks. So we've definitely seen utilizations grow in that front. And then looking more at the non-traditional equities and credit and other asset classes, secured funding remains top of mind from borrowers and repo counterparts. Feels like people are putting more and more emphasis on secured funding, whether it's non-cash off sec lending docs or repo trades off MRAs. So we're definitely trying to continue to beef up that part of the book for clients where collateral schedules maybe are a little bit more flexible. I don't think that trend is going to decrease at any point. This is a pretty good barometer of even when equity markets were going down some and we were fighting marks from a cash loan perspective. Secured funding demand was still there, even though if you're thinking about it from a theory standpoint, it's, less equities to fund, so maybe there's less equity funding. Might have had some of that in some shops, but for the most part, the narrative was still, if you have cash or HQLA to go, we will take it.
So the news that I've alluded to once or twice is that this week the SEC did come out with an exemptive and interpretive relief on Rule 15C3-3. And that's something that the market has spent a decade or more working on advocacy with the SEC and regulators to work towards that rule change to essentially allow the U.S. counterparts to somewhat be on a more equal footing with at least their global peers and to be able to post equity collateral for securities lending transactions versus equity loans. And so it's a big change and one that I think will take a little bit of time to play out through the market. This is by no means going to be a podcast on this topic in any detail, so don't expect that from us, at least not today. We're happy to dive into it in more detail if people are interested in it and can even maybe think about whether we bring someone on to more specifically talk about it. But what I would encourage people is two things. One is that ISLA Americas already came out with a white paper on the topic. They really spearheaded the advocacy work with the industry over those years and have a white paper that sort of focuses on what the new opportunity will be and perhaps how the market will evaluate the implementation of equity collateral more fully. But it's going to be an interesting cycle because there's a lot of market participants that have a lot of experience with equity collateral and with tri-party setup and all that goes into that. And then there's others that maybe need to set that up in order to fully ramp up and be able to operate in that collateral set. But then I think there's also going to be the question of what will be dealer preferences and where will they fall on the scale of what's most efficient to pledge, all while knowing that the trend in this market for at least some market participants would be that securities lending is quickly becoming securities financing, and the ability to raise cash in this market too is a priority for a lot of market participants. And so I think it'll be interesting to see how over the coming months and years it sort of finds a new equilibrium with this added collateral type allowed in the US. That's not to say though it's allowed in terms of pledging it, but not all lender types that are really prevalent in the US today can accept it. So US mutual funds are not allowed to accept equity collateral. And so there's probably still work to be done there to see if US mutual funds can also get similar exemptive relief to be able to accept equity collateral. And then if they do, then there's the process that follows in terms of review and analysis of sort of the risk profile of taking other collateral types, as well as board approvals, guidelines, setup work, documentation, tri-party, you name it. So it's a pretty big lift and a big project, I think, ahead. But it'll be interesting just how much those that are positioned to accept equities in the early days will potentially see additional flow and kind of incremental business or not. Something that I think that we can monitor closely over the course of time.
What's the client reaction been so far? I know it's only been a couple days, but
I think that large beneficial owners that are able to already accept equities, it depends on lender type, and those that don't have a regulatory reason why they can't accept it. If they're already taking in equities, I think they see it as potentially a competitive advantage in the near term to be able to just be flexible and adapt to changing broker demand. But I also think that long term, that'll start to normalize. But I do think that a lot of large lenders are more than happy to accept inequities and go from there. But oftentimes, those are the same lenders, though, that are very interested in running cash programs. So there's a little bit of a conflict there in terms of they might have preferences in terms of what is most efficient to them. That can sometimes run in conflict with the brokers.
Yeah, no, understood there. And then I'm not sure if you saw this. So I saw on LinkedIn, I think it was a couple of people that were retired that commented about working on this 15, 20 some odd years ago. And
Yes.
I thought it was a nice, highlighted the milestone when you have people on retirement, not only taking the time out of the day to post about their old job, but mention when they started working on this and things like that. So definitely
Yes.
coming.
Yeah, no, it's sort of one of those things that probably has both become a bit of industry lore, but also it's sort of like the joke of, oh, is this the year that 15C3 will be addressed? So to finally have it come through, it's a big celebration event, but it also feels like probably one of those things that I'm sure has felt as though it's been celebrated previously. So yeah, it's an interesting thing when something this long awaited does get over the line, but it's a great thing. And then to also happen on the back of the new capital rules that have been proposed in the US, and now they're in active comment period through June. And I think that there's a lot of expectation and hope that the US administration then will finalize those rules fairly efficiently following the comment period that will close in June. I think the general sentiment there also is a positive one for our industry in securities financing. While there's still probably new and different constraints that are being worked through, a lot of the change is ultimately probably a net positive to our market and to a lot of the banks that are involved in the market across the board, at least in terms of capital treatment and such. There's some good positive change and probably some additional advocacy work that I'm sure will be undertaken by the market in the coming months. So we'll see how that plays out ultimately, but it's much better than it had been proposed. And so I think the first round of proposal could have been pretty detrimental in some respects. And so I think that people see it as a win that the advocacy really did work across the market, and the new revised proposal seems overall a good thing. So I think market participants have welcomed that reproposal.
You think we lost all of our listeners with all the regulatory talk, or are
We
people
may
still?
have, yeah. Do you guys have any like April Fool's jokes or anything? Are either of you into April Fool's? Not really.
If you want to get home with my kids, I'll play a prank, but nothing yet.
I had
You don't,
nothing. I have a, I
you
have,
have nothing, Mike?
I have a buddy whose birthday it is, and it was always fun kind of growing up, but I think we've long grown out of that one.
Yeah. Okay. So we're boring is what we're saying.
Yeah.
That's good to know. Okay. What else is around the corner? Are we ever going to get, maybe it should be like, where in the world is Jim Maroney? And are we ever going to get Jim Maroney back? I mean, is that a worthy question for us?
I heard there was a Jim spotting, or at least via phone, so we know he's still kicking, which is good.
Oh, good. Okay. Well, that is good. I wasn't worried about that, but now I know I need to worry
Yeah.
about that. So thank you, Mike. All right. Well, I have a listener question, which you both, I think, could probably offer. Maybe all three of us could offer insight into. And the listener question is insights into your career paths and tips you have for juniors in the securities financing space. So maybe we can turn that into Mark, Mike. What would be sort of your number one or top two pieces of advice that you would give those that are just coming into this industry or market, if they're interested in growing their career in this space, what they might want to focus on? Mark has a lot of co-ops. Why does Mark get all the co-ops, Mike, by the way? Shouldn't you have a co-op?
I think the desk was grandfathered in, and Mark's taken it over and grown it.
It
No,
just dawned on me that Mark
I
has all the
know.
co-ops and Mike's trading desk doesn't have any co-op.
You know what? That's a good point. We're going to take that offline.
Let's address that. Okay, Mark, go ahead.
Cool. Well, I started at State Street in their securities lending group and risk management. I started in the spring of 2009 out of college. So obviously 2008 and 2009 was like a pretty tumultuous time for the industry and just kind of capital markets in general. And I think my point of advice for a junior person was just be willing to take on any task. I was part of a fairly senior team, so a lot of the more junior work obviously fell to me, but a lot of those things that maybe don't seem important can end up leading to new opportunities or incremental work or just new introductions. So I think just being willing to happily and eagerly take on different tasks is really important. And I've been at eSec for about 11 years now. At both those two places, I've been lucky to be surrounded by a lot of people I really respect. So I've always liked to take different things, and those people now have scattered around the industry in Boston. I like to take things from them that I can then apply to what I do. I know I can't perfectly mimic every person, but if I see someone be really convincing in a meeting, I'm like, oh, I could probably do it that way. So I always just try to replicate the things that I really respected about different people that I could then apply to myself. So I think that there's a lot of good examples that people bump into throughout the career. Not necessarily mentors in a sense, because it could happen just via osmosis, but just be kind of willing to learn from people that have done it before you. Because usually, if they've got to a certain place, they've done something right along the way. That's what I found.
That's great advice. I like that. And it's probably a great party trick at a securities finance reunion that you can do your impersonations of those you've admired and their style, right? If you've studied those that have come before you, you probably have a great party trick to replay back to them at some point.
Exactly.
All right. Mike, I know you have some good advice. What is
Yeah,
it?
no, I think some advice I took 10 years ago when I first started was don't be afraid to ask questions and admit something that you don't know. One of the best piece of advice I ever got was don't go into a meeting, whether it's internal or external, and don't say anything, right? Always have something to offer. Or if you're gonna just sit there quiet and take in information that you're probably not necessary in the meeting. So that's something I've always tried to take into meetings with me 10 years ago and I do now. And try to add something because even if you don't think it's an overly maybe important aspect to the conversation, maybe someone else thinks differently. Kind of along the lines of that is saying, I don't know, or I don't know that answer, and I will go find out, get that information for you. That's not a bad answer. I think there's so many people who are afraid to say, I don't know. So they try to come up with what the client or a stakeholder thinks they want the answer to be, whether or not that's accurate or not. I think saying I don't know and then doing the legwork to find out the answer is just as valuable as having the answer on the spot.
Yeah, I think that's great. And now we know why you talk in so many meetings. It's great.
Yeah, that is very true. Part of that is I just like to talk in general.
Mike, remember that estimate process I passed off to you when you were a newer hire?
Yeah, one of my first interactions with Mr. McNeil was I was 22 years old and he passed off like a dividend estimate model with all sorts of markets. And I had to somehow come up with some South Africa market information. And now, 10 years later, I realized he was just parting it off on me, but he pitched it in a very convincing way that it was a good learning opportunity for me to have exposure to the equity desk.
Yeah, it's a growth opportunity.
Yeah.
It's also probably why Mark has all the co-ops. He's
That-
pitching them on the growth opportunity.
All I remember from that time is that it was such a massive file that my bandwidth on my computer could not handle at the time. So I basically could only be in that all day.
Yeah, well, good, good, good. All right. Well, my piece of advice, since you both really are curious to know, I agree with everything you all have said, so I'll try not to repeat it. But I would also say, and it kind of somewhat dovetails with Mark, some of what you said, because I really do agree that you have to, and I think even throughout your career, always be willing to pick up whatever is needed in terms of the work product and be more than willing to be the team player that's being helpful. But I think finding ways to be valuable to others and finding ways to support and help other people, and whether that's doing someone a favor, whether that's doing something that might not in the moment benefit yourself, but it really does, I think, lay a good foundation of familiarity, relationship building with folks, but also people remember that. And they remember if you were able to support them in some way or to help them in some way, whether through just a task or through something else that was maybe more of a professional favor. Life is long and that comes back around and can really, I think, benefit you over time and increase your profile with those that are in your network and your peers, which I do think is helpful along the way. So that would be one of a list of probably many things, but there's a little tidbit for you. So listeners, if you didn't like that question, I recommend submitting a question. You can go to our website, probably either in our podcast section or somewhere similar. You should be able to find a place to submit a question. You do not have to tell us who you are. You don't have to give us your name or your company. And it's fair game, whatever you want to ask. We'll throw out the stuff that should be thrown out, but otherwise we'll bring it forward on a future podcast and look forward to incorporating what you want to hear about or what you want to know about. All right, guys, anything else?
We're going to do the IPO podcast soon, Brooke. So that was direct
Yes.
feedback. And there was the announcement regarding the NASDAQ 100 adding IPOs after only 15 trading sessions just yesterday. So we could probably fill up a good 45 minutes on that topic.
That's a good teaser for an upcoming podcast specific to the IPO market. But Mark, I was going to ask you, and maybe you can give me like a 30-second answer, because when you were talking earlier about Q1 activity and the decrease in specials, and you were talking about, I liked your SaaS apocalypse and all the other points, but I was going to ask just on IPOs, because I appreciate that we've thought that this year was going to be a really healthy IPO market, and we've seen some, and so it's not to say that they're not around, but I also know that there's been some pullback in some, at least because of the more global geopolitical environment and landscape around volatility, and like, is this the right time to come to market or not? Do you have a view? Is that doing much other than just maybe the number of IPOs that the market might see? Is that really doing anything to those stocks in terms of opportunity that we might see for securities lending, or is it just perhaps only going to reduce the potential flow in that market?
Yep. So I think Q1 just isn't really when we see a lot of IPOs come to market. So not really too concerning that we didn't see a lot of activity. But no, I think there's a couple really big private companies that are going to have valuations in the hundreds of billions to even trillions that are going to come to market. And if they do get added to main indices quicker, it could be a tremendous trade for beneficial owners. So it looks like they're going to be. Like I said, don't want to dive into it too much. We'll save it. But yeah, I think we're still on track to have a really good year for IPOs. So
Okay.
I think that was certainly an idea that was debated. Could we see less activity, which is fair in the context of the volatility the past couple of weeks, but there's no signs that these companies aren't going to come to market. So
Okay.
valuation,
Well,
they have to. That's my opinion.
yeah.
That's more anecdotal in my opinion. But
Okay. Well, for those companies, I hope all of that holds true. And I hope that there's no fear or pause that's put on that activity. But yeah, we'll keep an eye on it, and we'll do a podcast upcoming on IPOs. All right, listeners, this was fun. Mark, Mike, it was fun. Maybe it's just the three of us. We'll have to see if Jim even appears in the cartoon this go around.
that could be some outro music.
All right. Bye, friends.
All right. Bye.
Thanks, guys.
Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.